So most people have no idea how powerful depreciation is. Meanwhile, the richest individuals are using it to completely eliminate their taxes every single year.
Did you use that $916 million loss to avoid paying personal federal income taxes?
Of course I do. Of course I do. And so do all of her donors.
When ordinary people feel ripped off from paying a high amount of taxes, it is very common for them to want to know how they can pay little to no taxes like Donald Trump, or how Jeff Bezos or so-and-so pays so little in taxes in comparison to their large fortunes of wealth. Well, I'm about to show you how they buy assets, take large deductions against those assets, and use those same deductions to reduce very large portions of income on their tax returns to pay very little money in taxes. I'm also going to show you how they continue to use those assets to help them build even more wealth, which leads them to buy even more assets to offset even larger portions of their income, and how they literally follow this process on repeat to build tax-free wealth. And almost anyone can accomplish the same result if they adopt this philosophy, but not too many people actually understand it. So as a licensed CPA that has actually implemented this several times at mycpacoach.com, I am dedicating this video to fully break down this concept while referencing real life examples you can actually learn from. If that sounds good to you, go ahead and like this video and let's dive right in. Okay, so what exactly is depreciation? This is just a non-cash tax deduction that allows taxpayers to write off the cost of assets they own over time, even though those assets may in fact continue to go up in value. For example, let's think big here and say you bought a $10 million building. Well, the IRS may allow you to write off $2 million of that building as a loss on your tax return, even though that building may generate significant income and again, appreciate in value. And then you can use that same $2 million loss to offset up to $2 million of income reported on your tax return. Or if it just so happens to wipe out all of your income completely, you could just carry that loss forward to apply it to income you earn in the future. So the tax-free wealth hack here is that these depreciation deductions can be used to reduce your taxable income and your taxes without actually reducing your wealth, because these assets may continue to appreciate and generate income in the future. But there is some nuance to the actual rules and methods to accomplish this. So let's look at some real life examples of how the rich use this to offset their taxes, like the founder of Amazon, Jeff Bezos. So I want you to think about Amazon's business model for a second here. They own offices, warehouses, servers, equipment, and even delivery vans these days, right? Well, these are all tangible assets that Amazon uses to increase their revenue into the billions of dollars. And in return, they take depreciation on those assets to report little to no profit on their tax returns. In fact, it was reported that Jeff Bezos paid zero federal income tax in 2007, according to ProPublica, despite Amazon's stock doubling in value and his net worth increasing to be worth billions of dollars. In 2011, it was reported that he used investment losses to offset his income on his tax return by so much that he even qualified to take income-based tax credits for his children. So for everyday business owners watching this, you may want to think about things that you can buy and use in your own business that can also help you build more wealth while reducing your taxes at the same time. For medical professionals, that may involve buying new medical equipment and medical devices. For content creators, that might involve setting up a studio that you own or buying new cameras and video equipment. For service providers, that may involve buying a new work vehicle to get to and from your customers or equipment to better perform your jobs. For e-commerce businesses, that may involve buying a warehouse or simply investing into some type of storage or garage space. There are endless examples here, but the rich are able to make calculated investments into things that already align with their wealth strategy while mitigating their taxes at the same time. But business property is just one way to take advantage of this. But for many people, it is easier for them to simply invest into rental properties. So let's look at another famous example here, Donald Trump. Donald Trump has famously used real estate depreciation to offset his taxes for decades.
A lot of my write-off was depreciation and other things that Hillary as a senator allowed.
He owns residential property, commercial property, retail property, golf resorts, and more, which are all assets that he can take depreciation deductions against, and that he did. In 2017, it was reported that he claimed $47 million in losses, mostly from depreciation, which reduced his taxes to just $750 according to the New York Times. And even better, in 1995, it was reported that Trump declared a $915 million loss on his tax returns that was not only used to offset his taxes that year, but he carried the excess losses forward to cancel out his income in future tax years. Now, the good news here is that the exact tax provisions that Trump has famously taken advantage of are not unique to millionaires or billionaires. Ordinary investors can take advantage of the same exact tax provisions by simply investing into rental or investment properties. Some people even convert portions of their own personal residence into a rental property, while others may start by acquiring one small rental property at a time. And with every qualifying piece of property that they acquire, they are able to take depreciation deductions against those properties to largely offset their income and pay less taxes. But to get the maximum tax benefit, you also need to know how the rich supercharge their depreciation deductions. Oftentimes, they are not using regular depreciation to create these big tax write-offs. Regular depreciation forces you to take an even amount of depreciation over so many years, often resulting in very small deductions for most people. Instead, the ultra wealthy use accelerated depreciation methods to front load their depreciation and take larger amounts of it in earlier years. And common examples of those methods include Section 179, which allows businesses to immediately expense up to 100% of the cost of tangible property they purchase, which applies to property that can be physically touched and relocated, like business equipment and appliances. And another big one is bonus depreciation, which allows you to take an additional tax deduction, which is currently set to be 40% in 2025, and can also be applied to vehicles and certain components inside of real estate properties. And then there's also cost segregation, which is a staple when you are dealing with rental and investment property. And in very simple terms, this is just a study that allows you to accelerate the rate of depreciation you can take from your rental properties. So whenever you hear about people using depreciation or property to pay very little money in taxes, these methods are almost always in play here. But even once you create these very large depreciation deductions, you still need to understand the rules to actually apply those deductions against your actual income. So in simple terms, the tax law only allows you to take depreciation against the corresponding type of income that you earn. For example, rental income is considered passive. So if you take depreciation against a property that is only used for passive income, well, that deduction can generally only offset your passive income, not your earned or active income from your business or job. Whereas on the flip side, if you are taking depreciation against business property that is used to generate active or earned income, then that depreciation deduction can be used to offset that same type of income. And this is where understanding the tax law becomes very important, because there are actually provisions in the law that allow you to turn your passive losses into active losses that offset your ordinary income on your tax return. There is the real estate professional tax status, for example, the short-term rental tax loophole, and the ability to use C corporations to accomplish this as well. So look, if you're looking to use depreciation to reduce your taxes like the rich, nothing in the tax code is stopping you from doing so, other than having the right tax plan in place that supports it and making the decision to incorporate a depreciation strategy as a part of your wealth plan. And if you want me to drill deeper into any one of these topics, just drop a comment below, and if there's enough interest, I'll consider creating a video for you specifically here on our channel. Or if you need immediate assistance, just go to mycpacoach.com to apply to work with my team today.